Have you ever wondered how to leverage small investments for potentially significant returns? Pondered how to make your money work harder, faster, and smarter? Today, we're delving into the fascinating world of penny stocks and options trading, where the potential for significant gains exists for those willing to navigate its intricate landscape. First off, let's demystify what these terms mean. Penny stocks are typically low-priced stocks from small companies, trading for less than $5 per share. Options, on the other hand, are contracts that give the holder the right, but not the obligation, to buy or sell a stock at a predetermined price by a specific date. Now, let's explore 3 strategies for options trading with penny stocks. The first strategy is a long call. This is where you buy a call option with the expectation that the price of the stock will rise above the strike price before the expiration date. This is a bullish strategy, meaning it's utilized when you believe the stock price will go up. It involves purchasing an options contract, setting a strike price, and waiting for the stock price to rise. If it does, you have the right to purchase the stock at the lower strike price, potentially reaping a tidy profit. The second strategy is a protective put. This is essentially an insurance policy for your stock. By purchasing a put option, you have the right to sell your stock at a set price, regardless of how far it might fall in the market. This can mitigate potential losses and is a bearish strategy, meaning it's used when you believe the stock price will go down. The third and final strategy is the covered call. This involves selling a call option on a stock that you already own. This can generate income from the premium received from selling the call option. However, it also caps the upside potential if the stock price rises significantly. It's a neutral to slightly bullish strategy, meaning it's used when you expect the stock price to remain relatively stable or increase slightly. So, to recap, a long call is a bullish strategy used when you expect the stock price to rise. It can potentially yield substantial returns if the stock price surges beyond the strike price. A protective put is a bearish strategy used when you expect the stock price to fall. It can potentially protect against significant losses by allowing you to sell the stock at a set price, regardless of how far it may plummet. Lastly, a covered call is a neutral to slightly bullish strategy used when you anticipate the stock price to remain stable or increase slightly. It can provide a steady income stream from the premium received from selling the call option, but it does cap the upside potential. These strategies provide a dynamic approach for navigating the vast ocean of penny stocks and options trading. They allow for the leveraging of small investments for potentially significant returns, offering a way to enhance your portfolio without extensive capital outlay. Remember though, that while the potential for profit is enticing, these strategies also carry risk. Always conduct thorough research and consider seeking advice from financial professionals. In the world of penny stocks and options trading, the possibilities are as vast as they are exciting. It's a realm where small investments can potentially yield significant returns, where savvy strategies can make your money work harder, faster, and smarter. So why not dive in and explore the potential that penny stocks and options trading hold for you?